The Fed's announcement this month about what they're going to do with interest rates and how they're going to continue to support the economy was not a surprise at all. But what should you be doing about it? I got 3 things coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So if you were to look at what the Fed is doing to keep the economy and really the stock market afloat, it is absolutely unprecedented. I was doing a presentation recently with a local business, and we were looking at what the Fed did to their balance sheet in 2008 to rescue the worst economy since the Great Depression. No one wanted to buy anything at that point. And get this, the Fed needed to expand their balance sheet by $1 trillion. And that seems like nothing right now. The Fed has expanded their balance sheet about $4 trillion, continues to do more. And we're all looking around, and this virus is still very much a part of our lives, but vaccines are starting to be administered, and we've got stock market at all-time high. So we've got backlogs, we've got supply chain issues. People are wanting to buy things. We can't even provide enough supplies to meet the demand. And yet we've got this weird dichotomy because there's a lot of hurting people out there, and the Fed is looking and saying, we still are a long way from a full recovery. Employment levels are still way off of where they were at the beginning of the year. We did a video about that here just recently. And we still have substantial damage here in the economy that the Fed needs to continue to provide life support. The problem is, in 2008, 2009, we didn't get off life support for a decade. And now we've ramped up the life support even more, and it leaves me and many others worried about what in the world is ahead of us with the Fed's involvement in the economy and supporting things. So Fed Chairman Jerome Powell came out and basically said they will continue to buy bonds for a substantial period of time until we've seen a significant amount of recovery. So they're going to continue to invest assets and print money throw it into the economy, okay? And they also said we're going to keep interest rates at 0 or near 0, I think is what he said, but that basically means at 0, through at least 2023. That in Fed terminology, that's an eternity. That is an eternity. They meet frequently throughout the year, and if the only update is, we've done a video about this before, the only update is we're keeping it at 0, keeping it at 0, keeping it at 0. I mean, why even meet? Why even meet? So interest rates are going to stay at 0 for a long, long time. What should you do about it, okay? And the only question mark here was, well, the economy is really starting to take off, so it seems. Some believe that. Therefore, will the Fed change their posture? Will they start raising interest rates earlier? And they basically said no. So what does it mean? Number one, if you haven't refinanced your mortgage, you've got to consider doing that. You've got to. I know banks have been flooded with refinancing, but it is still something you must do if you haven't done it yet. To me, you've got to look at the rule. Do you think you'll still have this mortgage in 5 years? 5 years from now, will you still have this mortgage? That is, will you have moved or will you have paid this thing off within 5 years? If the answer is, yeah, I think I still have this mortgage in 5 years, and you can save about 1% on your interest rate, you got to do it. You got to refinance, okay? Obviously, there are other factors involved as well. Do you have enough equity? I've done a full video about this before, but do you have enough equity? Is your credit score strong? All that sort of stuff. But if yeah, then refinance. I talked to someone earlier who's got just about enough equity, right around 20%. Interest rate currently is over 4%. Yeah, you got to refinance. You've got to right now. So if that's you, or you still have other debt in your life that's maybe at higher interest rates, you've got to look at refinancing and capturing today's low interest rates. Don't overextend yourself with debt. This isn't a reason to take on more debt, but it is a reason to restructure the debt that you have. So make sure you refinance at these low interest rates. Will mortgage rates get lower? Possibly a little bit, But to me, they only go substantially lower if interest rates get negative. The only way interest rates get negative is for the economy to significantly worsen. And that risks all sorts of issues with the banks and so on. So to me, there's no benefit in waiting. Refinance if you haven't done so yet. The second thing I would tell you to do is something not to do, really, okay? So I'm gonna tell you not to spend your emergency fund. That's the second thing based on the Fed's announcement. Why? Because your emergency fund is paying you nothing. Interest rates have dropped. They're at zero, and they're gonna stay there for a long time. You might look at this and be opportunistic and say, well, then why am I keeping this 20 grand there? Why am I keeping this 10 grand there? Why am I keeping this 50 grand there? It's not doing anything for me. I should do something with it. Resist that temptation. Resist that temptation. That money, your emergency fund, your financial confidence account, is not there to make you rich. It's to keep you from being poor in case something terrible happens. Therefore, yes, you do care about the interest rate, you do, but if the most competitive interest rate out there is 0.5%, then that's what you get. That's it. Don't be tempted to say, well, I'm just going to spend this money. Who cares? I'm going to go, invest this money. I'm going to do something with this money because it's just sitting there. Yeah, that's sort of its purpose, to be there for you just in case you need it. Okay? Hopefully you don't need it. But what was the number one greatest regret polled by Americans during the pandemic? The number one was, I wish I had an emergency fund. I'm not making that up. That was reported by the news. Could have been fake news. I don't know. But that was the survey result from this spring. So don't be tempted. That's exactly why they reduced interest rates, to try and spur people to borrow more money and to spend their cash. Yes, and to a certain extent, that stuff is good and you should do it. But don't borrow too much where you're overextended, and don't spend all your cash where you have no safety net, no moat around your castle. So even though interest rates are going to stay low for a long time, don't be tempted to spend all of your emergency fund. Keep it safe and sound right there where you need it. The final thing that I would tell you with interest rates being low and staying low for a long time is, if you're planning on retiring, you've got a huge problem with interest rates. You've got to figure out how to replace your income, how to get income from investments when interest rates are going to stay at nothing for a long time. That means any company, any worthwhile company that's trying to borrow money and expand, or borrow money to keep themselves afloat, they're going to be able to issue their bonds at a much lower interest rate. They're going to pay you, the bondholder, a much lower interest rate to borrow money. And what that means is your retirement nest egg, your retirement dollars might not stretch as long, might not go as far for you. It will be harder for you to get a decent interest or decent income off of that portfolio. So you're going to have to work with your certified financial planner and see how much risk should you take with your bond or your income investments to get the income that you need. So you've got to work with your certified financial planner and say, can these dollars still last as long as I need them to? That's number one. Number two, where's the appropriate place for me to take to get income from? So for us, we're using more of our dynamic income strategy. All right, let's get as much income as we can, but if the tide turns and all of a sudden people go risk off and things start dropping, we can pivot into cash. We're doing more of that. We're looking more at real estate and some other income producing options to try to make sure our clients, and for you, are getting as much interest as possible during this time, a potentially long time of very, 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 very low interest rates. So work with your certified financial planner, make sure you're still on track, and make sure you're looking at all the right options to get as much interest as possible, even though it's not much, during this crazy time of low interest rates. So that's what I'd tell you to do. If you don't have a certified financial planner, make sure you reach out to someone on our team. You can find us online, corehorn.com, that's Corehorn with a K, or wisemoneyshow.com. You can find us there as well, or just send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.